we'll be discussing the concept of letting bad banks fail. Recently, regulators closed down Silicon Valley Bank and Signature Bank. SVB received a large influx of deposits as the Federal Reserve flooded the market with dollars during COVID. SVB went out and bought government bonds to store that money. But when the Federal Reserve started enacting policies which moved interest rates up, the bonds SVB purchased in the past declined in value. So, when rates rose, SVB's assets plummeted in value. Now, the key question is, what are we going to do about it? The most reasonable solution is to let bad banks fail. Although there will be some costs if the banks fail, people who invest in bad businesses should lose. Banks that destroy wealth shouldn't be allowed to continue to do so indefinitely. And when depositors make a run on bad banks, they're performing a public service. A bank bailout not only means taxpayers will be left holding the bag for bankers' mistakes, but it also screws up incentives in the banking industry even more. Bank bailouts create a moral hazard problem, where banks engage in risky behavior because they know they will receive a bailout no matter what. You cannot have a healthy free market when you privatize the profits and socialize the losses. The taxpayer's wallet, if treated like common property, will be subject to the tragedy of the commons. The FDIC already insures up to $250,000, meaning every depositor who has less than that in their account is getting their money back already. Business deals have risks. We cannot pay people to ignore that fact. If some individual wants to come along and buy failing banks and try to resuscitate them, they're welcome to try. But if the choice is between a bailout and letting them fail, the answer is clear. Let bad banks fail. If they can have the profits, they should have the losses as well. Subscribe Libertarian Facts.